This question will require us to prepare a statement of changes in shareholders' equity. Fancy Photos Corporation, a public company, reported the following balances as at January 1st, 2020. Common shares, we had 32,000 shares issued with a value of $800,000. Retained earnings, $1.5 million. Contributed surplus, $145,000. Accumulated other comprehensive income, $40,000. During the year ended December 31st, 2020, the following summary transactions occurred. Net income was $400,000. There was an unrealized gain on fair value through other comprehensive income investments of $25,000. There was a reduction in contributed surplus due to the repurchase of common shares of $17,500. There was a reduction of common shares due to the repurchase of 1,000 common shares, which was valued at $25,000. Dividends were declared of $70,000, and we issued 2,000 common shares for $100,000. And the first thing we're asked to do is prepare a statement of changes in shareholders' equity for the year as required under IFRS. Okay, so when we prepare a statement of changes in shareholders' equity, we need to remember that this is an official part of our financial statements. So we want to make sure that we're labeling our statements properly, the way that we would in the financial statements. And sometimes there's marks for this on exams. So we're going to start by saying Fancy Photos Corporation. I think it's corporation, is it? Yeah, Fancy Photos Corp. We're going to have statement of changes. Statement of changes in shareholders' equity. I'm using some abbreviations here just for space. And it's going to be for the year ended December 31st, 2020. Now, when we set up our statement, we're always going to start with the beginning of the year. So this is a continuity statement. So we're going to have the balance as at January 1st, 2020. We're going to have a variety of sections here. So we're going to have share capital. We're going to have the number and the value. We're going to have other contributed capital. We're going to have retained earnings. We're going to have AOCI. And we're going to have a total. So we're given the beginning balance at January 2020 in the question up here. So we're told that we had 32,000 common shares for a value of 800,000. So we're simply going to put in these numbers here, 32,000, and the value of that was 800,000. Or it's an 8. Other contributed capital. So we had contributed surplus up for 145,000. So let's put that there. We had retained earnings of 1.5 million. And we have AOCI of 40,000. And that's it. So 40,000. And then we're simply going to have our total, which is going to be 800,000. Obviously, we don't add in the number of shares. 800,000, 145, 1.5, and 40,000. So our total here, our total equity is going to be 2,485,000. Now we're given a variety of questions that happened throughout 2020, and we need to include these in our statement of changes. So the first thing that we're going to have is we're going to have usually net income goes towards the end, so we're not necessarily going to do these in order. So let's see what we can include in share capital. Start with that. So we reduced common shares and we issued common shares. So normally the first thing that we would say is we issued common shares. And what did we issue here? So we issued 2,000 common shares for 100,000. So we're going to add 2,000 to the count, and we're going to add 100,000 to the value. So now we've got this one, and let's look at this one. Reduced common shares during the year due to the repurchase of 1,000 common shares. So now we're going to have the repurchase of shares. And now we are going to reduce this by 1,000. And we are going to reduce, we paid out 25,000. So we're going to reduce our share capital by 25,000. So now we got this one. Let's look at this one next. We declare dividends. We declare dividends of $70,000 on common shares. So let's think about this. Where do dividends flow through? They don't flow through share capital. We know that dividends flow through retained earnings. So this is going to be a reduction to our retained earnings of $70,000. Got that. What else do we have here? The reduction of contributed surplus due to the repurchase of common shares. So reduction of contributed surplus due to the repurchase of common shares. So we repurchase shares here. So we're going to reduce our contributed surplus here. This transaction can be part of the same line because it's part of repurchasing shares. So we're going to have 17,500 here. These lines don't balance like you would in a journal entry. These aren't journal entries. This is a statement of changes. So we got this one, unrealized gain on fair value OCI investments. So we are going to have, so in our section here, we're going to call this comprehensive income. And we're going to have net income. And we're going to have unrealized gain. AOCI. So our net income that we were told in the question up here was 400,000. And of course, that's going to go through retained earnings as a positive. And the AOCI change is we're going to have $25,000 to go through AOCI, sorry. So 25,000 here. So now we've picked up all the transactions. The next thing that we need to do is update our totals. And so because we have, we mostly have one number on most lines, we can just simply grab those totals across here. We've got 25,000, 70, negative 1,000. Actually, sorry, this was, 100,000. Because this is the number column. We have to be careful here not to pick up this column because these are numbers. So we've got 25,000 and 17,500. So here we're going to have negative 42,500. Then we're going to have negative 70,000. It's a bracket. And then we're going to have 400,000 here in this line. And 25,000 in this line. So our new sum, if we sum across the top, the ending of our schedule here is going to be the balance December 31st, 2020, because it's a continuity. So you can see these are the transactions that are reconciling between the beginning balance on January 1st and the ending balance on December 31st. So we sum across the top and we sum across the bottom as well. So the total running down this way of all the numbers above is going to be 2,897,500. Then running across the side, all these share capital numbers, 2,000 minus 1,000 is going to give us 33,000. The value of the share capital is going to give us 875,000. the changes in other contributed capital are going to give us 127,500, which is the beginning balance plus the changes. Retained earnings, 1,830,000. And AOCI is going to be 65,000. Perfect. So you can see that that would sum across and down. So that's what our statement of changes in shareholders' equity looks like. So essentially, just to recap, we've set up the statement properly. We've got the name of the company, what the statement is, the statement of changes in shareholders' equity, and the period. And this is a year-ended statement because it's a reconciliation between the opening balance on January 1st, the transaction types, and the balance at December 31st. And you can see we've got a section for share capital, both the number of shares and the value of share capital. We've got other contributed capital, primarily contributed surplus, retained earnings, accumulated other comprehensive income, and then we've got a total. Okay, so we did this one. We did A, and B says prepare the shareholders' equity section of the statement of financial position at December 31st. Okay. So again, we're creating a part of it of a statement of financial position. So we might as well just label it. So we've got fancy photos. Statement of financial position. Partial, because we're not completing the whole statement. And this is as at December 31st, 2020. So our statement of financial position, the shareholders' equity section, is always going to start with share capital. We're going to start with the common shares. We're going to start with the fact how many common shares are authorized. So it says unlimited shares, unauthorized. So we're going to say here, we're going to say share capital, common shares, unlimited shares authorized. Authorized, okay. And then we're going to say we have 33,000 shares issued. And that's this number here. And that is going to have a value of 875,000. So we have 33,000 shares issued for $875,000. And we've got contributed surplus. Which is going to be this number, 127,500. All right, then we're going to have retained earnings. Which is going to be this number, 1,830,000. Then we're going to have accumulated other comprehensive income. Accumulated other comprehensive income, which is going to be this number, 65,000. So our total shareholders' equity is going to be 2,897,500. And that's what it would look like on our statement of financial position. So we completed the second part of this question. Let's take a look. C, how would the answer to parts A and B be different if Fancy Photos Corporation prepared financial statements in accordance with ASPE? Well, ultimately, ASPE does require changes in retained earnings to be presented in a statement of changes in retained earnings. The main difference between ASPE and IFRS is that ASPE doesn't recognize accumulated other comprehensive income. So we definitely wouldn't have that category in this statement of changes. And also, then ASPE does allow some flexibility in terms of the changes in capital accounts can be presented in the notes of the financial statements. But the main difference would, in substance, be the fact that AOCI would not be included. So that concludes Part C.